Is the banking sector, or can we say that as the banking sector, recovered from the shocks of COVID-19 and the recent economic challenges? Well, recent Bank of Ghana data suggests that it is stable, it is profitable, and the sector can indeed withstand shocks. But how is this development impacting on the banking sector itself? Or is that the situation on the ground? And is that also impacting on credit extension to businesses out there, or that is not the situation? Or maybe I'm going ahead of myself as I try to get more answers on this development as we look at the recovery of the banking sector and how that is impacting on credit extension in Ghana today. Well, I'll say that I'm indeed grateful to have the Chief Executive of the Ghana Association of Banks, John Awuah, to help me appreciate the issues on the ground after what the data has said, after what the Bank of Ghana has said, what is happening right now. So John Awuah, thank you so much for your time. And it's always a great opportunity to engage you on development in the banking industry.
Same here. Thank you very much for having me.
We had the governor of the Bank of Ghana during the recent MPC meeting. I mean, talked about how the sector has recovered strongly, withstanding shocks and all the rest and all the things. That is data. Some would say data don't lie. But also the reality on the ground. How are the banks doing as we speak right now?
Thank you very much. As you know, we've had some, bad few years behind us from COVID-19, and just when we were getting out of the woods, about on the impact of COVID, we had this economic situation that, as a country, we had to grapple with. And as you know, the banking sector really played a big role in the country securing the IMF-assisted program. So there's so much that has happened in the last couple of years that nearly, had some significant negative impact on the banking industry. But people forget that somewhere around 2017, there was this massive cleanup of the banking system, and that provided that shock absorber for the industry, and that perhaps is the key enabler, enabling force that enabled the banks to come through these difficult periods that we've had. And of course, from the reports that we've read from the central bank, the level of recovery that we've seen.
So we can confidently say that that cleanup that happened before has helped the bank to be quite resilient and build the required shock absorbers to withstand some of these shocks.
There is no denying that fact, that the banks that remained following the cleanup were the banks that were very solid, well managed, and were playing, having the right size and capital levels to manage the risk that confront the industry. So that must have played quite a significant role in providing the ammunition or the solid base for the banks to maneuver these difficult terrain.
But can we also say that we won't take away regulation, we won't take away the modeling that your members, individual banks, have modeled the operations over the years? And for some have even engaged in Bank of Ghana or even World Bank officials, let me use that word rather, they are shocked at the time that has taken for a lot of these commercial banks to quickly turn things around.
I like to
based on engagement with the World Bank.
Yes, I like to choose my words very carefully. Of course, the banks have gone through these kind of dips and troughs in our economic history. As a country, we've had very good times where the economic variables look in the right direction, and then all of a sudden you see them going into uncharted path. So as an industry, we've had experiences, and of course what experience does to you is like it helps you to build resilience, because you understand exactly how to maneuver during these difficult times. And I don't want to get ahead, or I don't want us to get ahead of ourselves, particularly around whether we are fully recovered, because most of the indicators that tend to worry the banking sector, they are more or less lagging indicators. A lot of a good performance can come before the indicators or the impact of the indicators also unravel and can hit whatever recovery efforts that have been done. There's so much that has been done. So the banks took the hit as was expected, as dictated by international financial reporting standards, and through that Of course, 2022 results we all saw, it was not a result that all of us anticipated. The banking industry lost significant amount of capital, and we have submitted capital restoration plans to the regulator to restore that capital levels. But of course, there's been recovery. Are we out of the woods? I would say we are still in transition because we want to get to the level where we look back and say the country is off clear because we are part of the country, we exist in the economy. And to the extent that the economy is not fully out of the woods, we wouldn't say that the banking industry is more or less operating outside of the economy, and therefore we are clean and dry.
You think that there are still some vulnerabilities that could expose the banks, because then as long as these things exist, we should still be careful and be on the lookout?
Yes, of course. We have already seen it on the impairment side, that while the banks are doing well, the impairment rates are still in the horizon. We are now around 20%. For every 100 cedis that you lend, if you are not able to recover 20 cedis, that is significant. If you look around the sub-region, we are about the highest. So it is not a statistic that, as an industry we are proud of, and banks are doing everything to unwind or to make some level of recovery, to reduce the level of impairment. But of course, most of these impairment numbers that the banks have recorded mimics where as a country we are. Why are businesses unable or struggling to pay? It means that the business environment is not completely out of the woods, and cash flow projections are not in line with perhaps expectations, and therefore there's a little bit of stress in business performance, which will definitely translate into the ability to perform on their facilities. The same goes for individuals. Of course, inflation has been trending downwards, which is good news. Purchasing power, of individuals, borrowers, have also kind of depreciated significantly as a result of the inflationary pressures that we've had in the past. And with all the other cost variables also inching upwards to some extent, the purchasing power of even individual borrowers is also at a certain level that perhaps may not be adequate to support the borrowing that they have taken, and that may translate.
I mean,
have
Mr.
a way of translating into the bank's financial performance.
Holding the business environment also constant, and we'll come back later to that. Also, can we still put the blame on what goes in the credit committee's decisions and all the rest, and doing also the right assessment to ensure that if a loan is given to Kobna Mensah or to Bosu Okai, the right scenarios and everything has been done, that at least we will have a default rate or delay in payment, maybe about 20% or 30%. Let's hold the economy constant. Let's hold the business environment constant. What about the banks themselves upping their game when it comes to due diligence to ensure that Kobna Mensah, the Bosu Okai, who is one of the biggest spare parts dealers at that area, meets his obligations to that commercial bank?
We've had this debate before, and over time, payment levels at 20% is not the first time we've recorded this. So banks learn from these experiences of distress in the portfolio quality. So yes, you could point to perhaps one or two infractions here and there, but it's not a thematic trend within the industry that the banks, for want of a better word, are reckless in lending.
I want to meet, as a credit officer, George, I want to meet my target, so therefore there's a large loan book I have, so I go out lending because I have a charge from you as my MD to meet my credit target.
If you know how the banks operate, one person does not take the
credit committee. The
credit committee, there are people sitting on the committee who are independent minded. They are not measured by the amount of credit that is generated. They are measured by the portfolio quality. Like the chief risk officer is an independent assessor of risk. So he is not interested in how many loans you have booked. He's interested in the quality of the loans you have booked. So there is a balance of power in the credit sanctioning process. And that is why very difficult for one person to work credit from origination all the way to disbursement. So yes, there may be some factors coming from what you have mentioned, but we should also understand that we are humans. If we know that there is no consequence or no proper consequence for our actions, it drives our behavior into certain direction. If you look at the the economic circumstance, or you look at the environment, the judicial system, and other institutional structures, that should facilitate recovery. Because it's not, even in America, in all the developed advanced world, they record distress facilities. The difference between what we have in Ghana and what they have is that when they go to court to make recovery, there are no inhibitions in their way. They go 1, 2, 3, 4. Within a couple of weeks, there is judgment, and then they are able to recover. It goes, and then payment levels are down. What do we see in Ghana? You find a situation where banks are in court for sometimes multiple years, 3 years, 5 years, to recover a facility. The amount of time, resources that is committed to this judicial process. Sometimes even when you have received judgment, enforcing the judgment alone, the inhibitions that are put in your way. So until people have, or people believe or know that when they default, the consequence can be dire. You will not be able to borrow from any bank, and the recovery effort from the bank can be swift because it will be aided by the institutional structures like the court system, lands commission, registrar of companies, EPA, all the other institutional arrangements that we have to facilitate and enhance the credit culture in the country. If we are all working in sync, then if you know, as Mr. George Wiafi, that Kwabena Mensah went to Bank A to borrow, and the consequence is that his house has been sold within a record time. When you are borrowing and your house is a collateral, you know that you cannot mess up because the system will catch you up, and that will improve the credit environment. That's what has happened elsewhere. It's not like the banks are not sanctioning the right credits. The default in a greater percentage of the time is coming from the borrower. Yes, the borrower may also face some challenges because of economic circumstances, business disruptions, supply chain disruptions. They can also have cash flow challenges. But overall, the inhibitions and the stumbling blocks and the hurdles that are put in the way of banks in their recovery efforts really contribute to that kind of situation that we have in the country, where people borrow and they decide that whether we pay or we will not pay. I have been to court as a witness where somebody owes a bank significant amount of money, was asked, how much can you pay? I can pay you 100,000 a month. Okay, case closed, 100,000 a month. How long would this take when somebody owes you 20 million and he says I can pay 100,000 a month? So these are very real facts. And if this person goes and the court says no, then the bank is mandated to sell whatever they can touch and attach to you. Then he knows that there is consequence for default.
Mr. Way, I also want to hold this challenge that you've identified also as a constant in this equation you're trying to work out here. Again, let me also come to what has also stopped the banks and even the regulator. I've had instances where I've gone through the books of certain banks where there was an individual who was cutting across borrowing from Bank A, Bank B. This wasn't the syndicated facility. This was over the period. If it's identified that Mr. Menu is a problem, not because he cannot pay, but even the exposure, the regulatory limits that Bank of Ghana enforces you to enforce about don't expose yourself more than 10% to an entity, a facility, and all the rest. What has stopped the commercial banks? What has stopped the Bank of Ghana working to ensure that if an individual or an entity or a company is identified as having a high default rate, that person is blacklisted?
Yeah, I mean, there are regulations.
Are you doing that?
We are. There's a credit reference bureau that the banks report on the quality, on data on credit. If you borrow from a bank on monthly basis, we are supposed to be reporting to the credit reference bureau. And the regulator requires banks that in generating new loans, you need to check on the reference of the borrower from the credit. Are
you doing that? Are your members
doing that? I can promise you that banks are doing that. Right now. If the Bank of Ghana comes on on-site review and they see that in the credit file there is no file, that you've seen data from the credit reference portal that says that this borrower is clean, or even if he has a facility, he's performing, even if it's distressed, there's an explanation that is acceptable, and you've gone ahead to lend, you have regulatory
Has
sanctions.
there been an instance where you had to blacklist some entities and individuals because of, one, their exposure, and you realize that on 2 or 3 occasions, they are servicing a loan that they have actually failed to honor?
I'm not at an industry level because individual banks take their own decisions. And of course, if a customer is blacklisted, the customer is known to the bank that blacklisted him or her or the company. But whether as an industry you have a list of blacklisted customers because of default, your default should blacklist you automatically.
Should we get there where the industry there? Because I'm looking at a situation where the impact of this on the NPLs as an industry. Because you have a situation where this bad person, I use that in quote, goes on and affect other banks.
You see, the situation is, I think we are getting there. We are getting there because working with Bank of Ghana and the Seaboard, NPA, we are extending the credit references to other areas. Because as it is now, if you, George, you have defaulted in your rent payment, your banker has no way of knowing whether you are a defaulter. And someone who has defaulted paying rent is more likely to also default when he takes a loan.
Credit, yeah.
You understand? But elsewhere, if you default in borrowing on a supplier's credit, it goes to your credit. If you default in rent payment, it goes to your credit. It goes to improve or weaken your credit stance. So if the bank is looking at you, the bank has a 360 view of your credit performance or your credit worthiness. And the bank is then better armed to take the decision around you and profile you accordingly depending on how you have lived in your credit life. Yeah. Here, if a bank is lending to you, the best case we can have is whether you are borrowed from another bank. Whether you are borrowed from maybe a family member or even a business, or you are a businessman of taking supplier's credit, the bank has no way of knowing. But now there's going to be a beef up in the credit reporting, and we are starting with the oil companies, oil marketing, the BDCs, and all the businesses within that chain to broaden the credit reporting scope. And I'm sure in the course of time that the central bank will be coming out with an announcement on that. As we do that and gradually rope in the real estate owners, we rope in wholesalers, importers, then everybody is doing credit reporting to a portal. Then if I print out a credit history of someone, I'm not just looking at their obligations to the financial system. I'm looking at their non-financial obligations and how they are performing on those as well. And that should enable us to clean up. Elsewhere, people are not paying because they love paying loan. They know if they don't pay, there are significant consequences. It gets to a point you can't even get a property to rent because of your credit history. You understand? We have to get there where the system drives the behavior. Now it is more or less like the banks are doing everything. But how much when you are dealing with a customer or a borrower who from day one maybe is coming with the intent not to pay, knowing very well that the system will enable that behavior.
This is PM Express Business Edition as we look at the recovery of the banking sector and how that could impact on credit extension. We'll be right back after this break. Welcome back to PM Express Business Edition as we look at the banking sector and whether they have indeed recovered and whether that is influencing the operations when it comes to engaging businesses, individuals, especially in the area of credit extension. So we're getting your thoughts again about the issue about credit extension, the challenges that you're going through. The business environment, how has that been critical in people repaying their loans?
It's a tough environment. If you have discussions with business owners, they tell you it's tough. Of course, we see the recovery is a bit slow, but of course, if they are struggling, as banks, we are a residual home for default in the environment. If a businessman is struggling, then the probability that he's going to struggle to repay his facility or the facilities that they've taken from the banking system will be affected. So clearly, we need to, all of us, refocus the economy, make sure that the recovery is accelerated in a manner that enables the business community to also rise to the occasion. You have been interviewing them and they've been talking a lot about taxes, about issues of inflation, which likely is coming down, lending rate, which is also driven by economic factors. So until we have these variables all working very well together and trending in the right direction, we will continue having these kind of wobbly grounds for at least in the short term. Recovery is painful.
Yeah.
It doesn't just happen overnight. It takes some time and some effort. I'm sure businesses are also recalibrating their systems to be able to weather the storm during these periods where the country as a whole is recovering from where we were last year.
You talked about the courts and all the other externalities as well. What has been the engagement from your end in trying to engage judiciary about it? In time past, certain things there have been special courts and all the rest, and engaging all these external partners for them to appreciate the impact of those who are deliberately not trying to pay back these loans, and what measures are being put in place to deal with that challenge.
Yeah, in that area, I must say that we are making some very, very good progress. And here I would like to thank the Honorable Chief Justice, her leadership, Justice Tokono, for all the work that she's been doing with us at the banking industry. She has actually promised us that she wants to make this her pet project while she's in office, to rid the system of all the difficulties and enable the financial system. Because if the loan recovery is slow, the ability of banks to lend more is inhibited. So, and she understands that linkage very well and has promised us. And as banks, we are also working very actively with her office to see how best we can collaborate to improve the recovery effort through the court system. As banks, even in this year, we voted some amount of money to train the judges in areas that we believe perhaps there are some lacunas in the law that the lawyers are playing the court around. And if we get the experts to maybe take and refresh the judges or justices on these areas, particularly to do with the GIMRA process and also with the Borrowers and Lenders Act, certain areas within the Borrowers and Lenders Act. And these are all things that in the course of this year at the banking sector will be working with the Judicial Training Institute to embark on this training program for the judges, all in an attempt at bringing them also up to speed on some of the financial constraints that some of the judgments imposed on the banks.
Is a special court in the offing or something that is being looked at?
We have specifically asked the Chief Justice, her leadership, to positively look at that. If we have a commercial court. Commercial court deals with live cases, but if you can have a distress court, a court that deals with delinquent accounts, so that there is strict timeline, maybe it sits on weekends, Sundays, Saturdays, every day, holidays, that court is sitting, then borrowers will know. And then we, the lenders, will be guided that if we don't lend safely, there is a recourse, or you lend and there is a default or distress along the line, then there is a recourse. And borrowers will also know that if some information flow did not come through properly, they can also have recourse. Because it's not just one-way traffic. In the lending arrangement, we have a duty to also be transparent to the borrower. If there are any fees that are not properly disclosed and which may have interest that are not properly disclosed, which may have contributed to the default, the borrower must also have a recourse. And that court will be a very good place for the players within this borrowing and lending business to have a day in court that can determine these cases within the shortest possible time. Maybe a week, 2 weeks, 3 weeks, and it's done, and then we don't have
so it's something
issues.
That is being discussed.
We don't have any update on that, but it's something that we have recommended to the Chief Justice.
You mentioned one critical thing. Even recently, there was a Bank of Ghana directive on that, in ensuring that every prospective borrower appreciates everything when it comes to the agreement. And if you don't publish all those things, it could then leave the facility as null and void. What are the banks doing it in this space? If I got that directive right and I stand to be educated, by making sure that dotting the T's, dotting the I's, and everything should be made out clear to that person who's coming to borrow from you?
Exactly that, and that's exactly what the banks are doing now. So now, aside the offer letter that the bank will give to you, they also give you something, I don't know whether to call it a discovery or a transparency sheet, something that also lets the various facility, the facility and all the covenants, the interest covenants, the commissions, if there are any facility fees or processing fee, everything should be properly disclosed on this sheet. And the borrower must sign that I understand that these are my obligations and that I have been made aware of these obligations. So it is clear. And we are a highly regulated industry. Yeah. So when our regulator issues a directive, we only have one option.
Should they have taken the Bank of Ghana to remind some of your members about this? Because again, it became a problem. People say they enter into facilities and later it's like, I wasn't aware about this.
You see,
I wasn't aware.
Let me tell you something. Experiences that
is it deliberate on the part of people who are taking the loans or what?
As someone who has been in mainstream banking before, I can tell you, the average borrower in Ghana or a Ghanaian borrower or borrower in Ghana, let's put it that way, when they take an offer letter, the first place they are looking for is where is the signature. Where do I have to sign? The bank will make all the efforts to explain. But at the time of facility approval and offer letter is ready, the borrower it's a responsibility, a duty. While the bank has a duty of care to explain the covenants to you, you owe yourself a duty to understand those covenants. If you don't, you can seek the bank's advice or even a third-party advice on the various covenants the bank is asking you to sign up to. But what we see, if it is a 5-page document, you give to the borrower 1, 2, 3, 4, 5, where's the dotted lines?
She's desperate to get the facility.
Desperate to get the facility.
In the past,
so sometimes people have signed on to facilities that they have not really understood all the covenants around the facility. It's not that the bank has not taken them through. Even when you are explaining, their mind is on the money that is coming. So the covenants are going the other way. It's okay, how much? I applied for 500, only 400 is approved. And so the debate is on the amount and the interest rate. But there are other covenants. You have to pay quarterly, you have to pay monthly. If you don't pay, there's default, there's penal rate. All those things are little pieces of information that you, the borrower, must take into account to assess your capacity to repay. You understand? But the bank will disclose this to you, but you have a duty to also educate yourself and understand that this facility I've taken, these are my programmed repayments, and these are the sources from where I'm going to get the money to make the repayment. If you do that, I can assure you, if the bank has gone through the rigor of assessing your cash flow projections in the way they have to, and you also understand your business properly and your cash flow projections are really in line with your business, there's no way you should struggle to make the repayment, because the repayment is not taking away every bit of your cash flow. It's just a plug-in into your various cash flow and the cash outflows. So it shouldn't be. But as I said, the banks will educate you. The relationship manager or relationship officer, that's their duty. Before you sign, they explain to you, this is the facility, this is the tenor, this is that, if there's moratorium, this is the period. You have to start paying interest on this date, that date. If you don't pay and it goes beyond that number of days, you enter into default and there will be penal rate. It only gets to the point where there is default when the penal rate starts kicking in, before the borrower says, I got a debit on my account, I don't understand. But that debit, the borrower has already signed on to. You understand? So it goes beyond what the central bank has said, which the banks are complying. But as borrowers, we also owe ourselves the duty of care to ourselves to explain, to understand.
So some more education. But let's come to how this challenge has impacted on fresh lending and even new lending. Again, I go through the Bank of Ghana data and it talks about how credit has dipped so much to businesses and the general business sector and all the rest. How has this challenge made it difficult for fresh lending? It's not just on the non-performing loans. We need to also look at the macro fundamentals and where we are
as a country, as an industry as well. Lending rate is upwards of 30%. I think about 33% on average or thereabout. So you ask yourself, so banks, knowing very well that they lend to recover. They don't lend with the intention that you go and do whatever you like with the money. When you feel like it, you come and give us the money. They lend, give you a period during which or within which they have to get the money back. So if the lending cost or the interest cost is at a level that could potentially worry or give you some difficulty in making the repayment, the bank will be careful in sanctioning.
So why you say the high interest rate doesn't help? Because there are some who say that banks in Ghana are profitable because of the high interest that you're paying.
No. If you look at the banks,
who want to contest that.
If you look at the bank's performance, I mean, this is February. From next month, you'll be seeing the publications. I can tell you that yes, interest income is up, but interest expense is also significantly up. So as interest rate goes up, it's not just the lending rate that goes up. The borrowing, the deposit rate on deposit also go up. So as banks operate in an environment where the cost of funds is high, policy rate is 29%, Ghana reference rate is at 31%. Where do you want the bank to lend? Ghana reference rate is the benchmark rate. It's at 31. What rate do you want the banks to lend? So it's the fundamentals that drive the interest rate. Banks before 2022, the average lending rate was around 20%. Inflation, I believe, was around 13 or 12%. What's the name? The 91-day benchmark was around 13.5%. Banks lending rate, some banks were lending at 17, 18%. Nobody told the banks to do this. It's the macro variables and fundamentals that moved or trended in a direction that enabled the banks to respond.
So if the macro situation improves, automatically the cost of credit.
I have a graph here that I'll show you before you leave here. And I'll show you over the period, whenever rates have trended, the lending rate has followed suit. And in some cases, or in fact, a majority of the cases, when it is trending downwards, the lending rate trends more aggressively downwards. And that file or that graph, I've demonstrated it in a meeting with IEA before, because they were talking about lending rates, and I showed it to them. And even on their own graph in that meeting, I pointed them to that fundamental fact that it is the other rates that drive the lending rate. The lending rate is a derivative. It's not a rate that just comes. It is an interplay of the Ghana reference rate, and Ghana reference rate is an interplay of three variables. You have the interbank rate, you have the policy rate, and you have the 91-day benchmark. So if that rate, which is supposed to be the floor of lending rate, is at 31, where should the bank be lending?
Mr. What was the impact of this on new credit? Because there are some who are saying that the banks are not lending. What is this on Kojo Mensah, who has a viable business and everything and wants to approach Mr. Ewuah Bank? Are you lending, and are you going to lend to fresh lending to businesses?
Sitting here, I have not heard, and even yesterday we had a meeting here. I've not heard from any bank that is saying that we have frozen credit.
Cutting down, reducing the loan book,
it's a demand and supply.
Restrictions.
Business people, individuals are rational beings. If they know the lending rate where it is will affect their ability to generate the right revenues or the right profitability in terms of their business environment, why would they come demanding loans? So it's a demand and supply issue. The banks cannot throw money onto businesses and individuals. People must assess their need for the facility and approach a bank. Or a bank will go and explain, this facility we can assist you. But if they calibrate their cash flow with an interest rate of around 35%, and they see that it's not viable, why would they come knocking at the bank's doors for loans?
The request for loan itself has also come down, right?
I should think so. I don't have
But I'm just saying that with all these challenges, are we seeing banks now sit back and introduce extra layers and be more cautious in lending?
I've seen banks advertising. I've heard banks.
So they are still lending.
Yes, I've heard banks
advertising. Are they going to go to good businesses?
Good businesses, projects bankable projects
that can pay back.
Can pay back, and it's all in the cash flow and the cycle of the facility.
Mr. Well, when you come back, loans lending has reduced, but where are the banks now moving? The banks learned their lessons coming on the back of the domestic direction program. This is PM Express engaging the Chief Executive of the Ghana Association of Banks as we look at the recovery of the banking sector and how this is impacting on lending, on credit, on you as a business person out there. Do you want a loan and are you struggling to get that? This is PM Express Business Edition. Right back after this break. Welcome back to PM Express Business Edition as we talk about the banking sector recovery and how is this recovery impacting on lending. If the banks are doing well, obviously that should impact on lending. But the data is saying otherwise. I mean, lending is contracting, but I still look at your books and the banks are heavy in treasury bills. Some are saying that the banks haven't learned their lessons from the domestic direction programs that are going on. You are still heavy in treasury bills.
I wouldn't say heavy, of course.
Because you're not lending to business, obviously there's a cheap way to make some good returns.
Yeah, not that. And again, I wouldn't say not lending to businesses. The demand side is.
If I look at your portfolio in terms of the position,
the demand side is also weak. Yeah, we must know that. And if banks take deposits and there's cost to those deposits, it has to find a home. And of course, government machinery must also be funded. I can tell you that as far as I know, a lot of the banks have instituted internal measures on exposure to government, particularly sovereign exposure. You must know that given where we are coming from, there is no bank that is just on a wholesale basis just saying stop everything and let's go that direction. I do not think that is the situation. But of course, as the confidence in the banking industry increases and the trust has built up, it's also moving in the right direction and deposit levels are growing. Of course, there's liquidity within the banking system that must find a home. And if government on a short-term basis needs some hands to manage its liquidity or its the demand on this, like the public finances, of course, the banking system should be there to facilitate that.
But some will say that banks are not for the Christmas. These are shareholders' funds, these are creditors' funds.
Yeah, and that money is not going for free.
I know. So whether government is having challenges, some are saying that we are seeing what happened with the debt restructuring. That some will say that never again. If I'm a bigger shareholder in a commercial bank, I'll tell that bank that look for other avenues to invest these funds.
Yeah, banks are obviously looking at all avenues, facilitating other trade, embarking on aggressive businesses on the non-funded income area, and also looking out for bankable projects where they can, place their liquidity and expect some good returns. But of course, as I said, when we went through the debt exchange, we didn't go in with the understanding that there will be no more lending to government. Nobody said that. We actually intentionally working with the managers of the economy created a window of liquidity provision to the government in the short end to enable government machinery to run. We have an economy also to build. So do you know what will happen if subscriptions are maybe 10% subscribed and government is unable to run the payroll? And public sector workers are on the streets, and there is no light. And do you know what the consequence of that will be? So, as an economic participant, or banks as active participants in the economy, we cannot also fold our hands. But as I said, banks are, doing asset allocation with their eyes very boldly open. And I'm not sure there is any bank that is recklessly just throwing everything as security.
Some will say that, God forbid, if there should be another debt restructuring on T-bills, the banks will have their hands bent.
I'm not sure.
If that should happen, the banks will have their hands bent again.
I'm not sure. Of course, I mean, if you give...
Because of the exposure.
From what we have seen, having zero risk instrument is almost difficult to exist or not existent in our part of the world, at least for now. So anything can happen. But we know that from the performance on the ECF, we know that the covenants are being met. The disbursements have come, which have even helped in the management of our FX volatilities. So yes, we cannot say that it is foolproof, that nothing can happen. It's demand and supply, and also borrowing and lending. And whenever there's borrowing and lending, there's the potential that the borrower may show signs of default. But that is the only one. The comfort is that is the only window that is open to government. So if that window closes, then it's like we are closing the country.
They can't afford
so
to do
they
that.
cannot. There is that thing. It's almost unthinkable to go on that tangent.
Are the banks struggling to find prudent avenues to make monies on the liquid that they are holding? Because it appears that if it's not lending, then it's government. Even the Bank of Ghana, the governor himself, has admitted about the level of liquidity that the banks are holding right now. Are the banks struggling to find avenues, non-income and all the rest, to make some good returns on them? Because it appears that you're still sitting on huge liquidity.
The thing is, if an economy is not expanding or growing at a certain pace, then of course there's a bit of squeeze within the environment, and perhaps projects that an economy that hitherto was growing at 8%, projects and businesses and factories that were being built in those periods, now they are same thing may be happening but on a lesser scale. Then it means that the avenue for maneuver is a bit contracted. But banks are doing a lot. And as I said, you listen to the radio, you watch the TV, banks are advertised, they are calling people with good projects to approach. And the banks are ready to fund. And there are transactions, nice transactions that are ongoing on the individual front, on the real estate. You see the cranes are up. There are banks behind those cranes. It's not, just cash.
Recently, Casapreco did the facility.
All those ones supported by a bank. So there are good projects, and banks are very open to supporting businesses that have very good projects and to support them to deliver on those projects.
Inflation is going down, policy rate is going down. How are these variables impacting on, or would they impact on lending? Because now, again, look at the real interest rate as well, that because of inflation has come down and all the rest. How are all these variables impacting on your lending ability as a commercial bank?
Yeah, inflation is the devil is high.
It's still high, but at least we've seen some.
Yeah, and we have seen, and that's why we are very excited at the trend that we have witnessed some disinflation for several months now, except for I think January, where we had this marginal spike. The government statistician clearly explained why that happened. So we are on the lookout, and we understand exactly why the central bank, in spite of the significant reduction in inflation, still more or less held on to the policy rate, not to be bullish in reducing the policy rate. Because the policy stance is important, that we do not also get ahead of ourselves and be aggressive in pulling down the plug, like bringing the policy rate down to maybe 18%, and all of a sudden we have inflation on our hands at 54 again. So these things, and I said, recovery is very painful. When things are getting worse, it can happen like waterfall,
snowball,
you understand. But if you are building, it's painful, and we need to be patient. That inflation is coming down. As it comes down, lending rates will follow, and we are just hoping that the inflationary pressures continue on that downward spiral, and we get to maybe 20s, 18s, 17s, and you find interest rates in their mid-20s.
So that's a strategy from you, that as long as you see that
as long as we see that trend, it will transmit through the other variables, the T-bill, the interbank rate, and the policy rate, and
T-bills are dropping, the rates are dropping.
Yeah, they are dropping, but
so all these variables are going to impact as aggressive as we want.
Yeah.
But if these variables continue, that would impact.
We will see it. We've seen it before. I don't even. You just have to look at history. You just have to. We've seen it. inflation came to single digit, T-bill was at 12.5, and lending rate was around 18. You understand? So it's not like banks take delight in higher interest rate, because the higher the interest rate, the higher the propensity to default.
For those loans that were secured under variable terms, are these dropping inflation and policy rate impacting them?
I mean, if you were a borrower
I'm just asking,
and you signed on to a variable rate loan,
it takes time. Some are saying the banks will respond when these indicators are going down.
Once that we publish the Ghana reference rate the first Wednesday of every month, and the bank, if we delay in publishing it, the telephone calls that will be coming here.
So you are responding to the policy rate reduction.
The banks want it quickly
you are
to
responding to the inflation rate reduction
update their
in their loans.
Of course, once you have a variable rate, if you have a variable rate loan, as rates come down, you are benefiting. Let's
look at the IMF program and how that has also impacted on your operations, international credit lines and all the rest. There were some, and especially a critical factor in terms of the progress being made on negotiations with our bilateral creditors and all the rest. Has that development impacted on your dealings with partners outside, now that we hear that development partners are coming into resumption of projects? How are all these economic variables and development impacting on your operations?
No, I mean, not now. I think the movement is positive. People are ready to listen to banks. Of course, we are coming from an environment where we were, almost on a spiral, being downgraded. And once you get to a certain level in your downgrade, almost get into a junk status, then your external parties will begin looking at you in a certain way. There are some international banks that, by their own internal policies, if your sovereign rating is at a certain level, they cannot deal with the country. And there are banks like that. So it's not like banks in Ghana that have caused anything, but by the workings of a certain policy outside the shores of this country. So as our circumstances improve, we perform very well on the ECF, and the macro fundamentals move in the direction that we've seen in the last couple of months. The market will begin reacting positively, and we will see the offshore players gradually showing massive interest.
Are they showing interest since the
I don't have the data. I wouldn't be able to comment on that. I don't have the data. But I'm sure at the right time, when I pick up the data, I'll be able to update you whether there's been some good flows coming in from that direction. But Ghana is a good name. And until the recent issues that we've had, we've been, the darling of the offshore investors. And I don't think we don't have that capacity of getting back into the space where they look at us like how they look at even some of the advanced countries.
We know that Q1 it's normal. We always have the pressures. Are you getting the required supply in terms of dollar demand from the Bank of Ghana to meet your operations, or it's quite minimal? How are things in terms of the dollar supply, even though we know that K1 is always an exceptional situation in terms of demand for FX?
Yeah. As a country, we've never had enough dollars as a country, but the central bank's program on, particularly for the oil sector, has really helped, where there's proper auction just dedicated to the oil sector, because it was that sector that was exerting significant stress and creating a lot of volatilities in the FX arena. The IMF disbursement has helped. In December, the Cocoa Board money also came. All this, the World Bank is also coming in. So, of course, I'm sure our reserves is pretty, not in a healthy environment, but has moved up towards a point where we'll begin saying that our FX shocks are better.
I this question
so that gives Bank of Ghana, the requisite tools to also intervene in the market when there is significant stress to manage the volatility.
But has this intervention been strategic and a little bit okay for you, or you would have wished more intervention to meet your demand?
As for volatility, if one would say we want 1% to 3% volatility in the currency at the maximum. So anything outside that range is something that, of course, could be better. But under the circumstance, I think as a country, we are doing pretty well.
How has the volatility impacted on your operations? I mean, in terms of dealing the FX space, the clearance issues, and all the rest. It brings some pressure on the banks.
Well, it's not just the banks. If there's volatility and it negatively impacts the business community, it transmits to the banking system. So volatility is not a good thing because it doesn't facilitate planning. So anything that business people like to plan and they want to have some certainty within the planning horizon. And if volatility creates that kind of yo-yoing in your outlook, then it's difficult for you to plan. If you are unable to plan properly, your business can be disrupted, your cash flow can be disrupted, and that means a bank can suffer. So volatility is not a friend of the industry, and we are very much interested in what the central bank is doing to make sure the environment is relatively stable, which is something we have seen from all the way September, October, coming all the way to now.
We will celebrate regulation this time, but some are saying that, again, too much regulation when it comes to enforcing the trade, the FX shoes. Sometimes even anytime a bank is doing an FX transaction, they're just watching their back to ensure that they don't even miss a dot, because then that is also bringing some pressure onto the commercial banks.
Dollar is not our currency.
Yeah.
So me, I'm for anything that we do to make sure that our appetite for dollar comes down. I am 100% for it.
That's something the Bank of Ghana has been harsh on you guys and enforcing the FX rules, the trade rules, and all the rest.
If it is not new rules and rules that we have already subscribed and they are enforcing what is on the books, then the Bank of Ghana is just doing their job. It becomes a problem where maybe what is on the books, there is layer which is outside the scope of what we know, and that is leading to an outcome that affects the bank, then that is a problem. But to the extent that is either a directive, a notice, or Act 930, or any other regulation that is being enforced, we have already subscribed to that, and we cannot complain.
With capitalization of the banks, have all the banks, the Bank of Ghana said that they are all in position to meet the capital. That's just the plan. Are all the banks on track to meet the capital?
I think the central bank spoke.
Has the central bank discussed with you the capital levels that you should post
the governor's response
depending on your risk?
The governor's response was very clear that banks are on track to meeting the capital requirements, and so we have to keep it at that.
How that is going to be funded? Shareholders injection,
and you just
raising capital.
There are banks that are raising capital. There are banks that are also making the right returns on their performance to be able to capitalize from within. There are banks that are going right issue. There are banks that are okay as we speak, and there are banks that are going through the Ghana Financial Stability Fund.
Your levels are now 400 million Ghana cedis. Some are saying $1 billion would not be out of place.
I'm not a fan of setting up significant.
But has the levels been then set for the bank? Has the Bank of Ghana discussed the right levels?
Capital levels should be commensurate with the risk you are taking. So if a bank wants to be a small bank, then why $1 billion for capital? Because maybe they want to deal with SMEs. They want why $1 billion. So it is about capital management and making sure that as you assume risks, you are posting capital to be able to absorb shocks from those risks. It should not be the other way around. And the capital levels that we have perhaps is adequate for our economy and for who we are as a country. But there are banks that have $2 billion in equity in Ghana. There are banks with 1.something billion. But the regulatory minimum is 400. It means they have risks they have assumed and they have the capital to support that risk. So, over-capitalization can also be a problem. It can be a waste. If you are at let's say 600 million and your capital adequacy is 18 or 20%, if it increases to 1 billion, you are going to have a capital adequacy ratio of about 50% or thereabout. For what? So it is about commensurate capital to risk, making sure that you are properly matching and you have the adequate prudential buffer to enable you operate.
But has the Bank of Ghana discussed any levels with you in their discussion of that? The bank
no, the central bank has not raised any issue around increasing capital.
Finally, for you on the outlook going forward, what should we expect? Some exciting times or listen, the challenges.
I think as a country, our work is cut out
in the
for
banking
us.
sector, yeah.
Yeah, our work is cut out for us. We are in an election year and it's a testing year. So we all have to put our hands on deck, make sure that the commitments we have made under the ECF, we stick to that. And we do not go outside the scope of what we have committed to doing. That is the only thing that will ensure that our recovery path is elongated into the long term, and it helps the business community and by extension those of us who also live in the country to have some breathing space and enjoy from the recovery or the pace of the recovery that we anticipate. If we do not do that and we flip-flop, then it will not be good news for the country. But I believe that having heard from the managers of the economy, having heard from the central bank and other actors, key actors in the economy, everybody is watching that space to make sure that as a country we travel that narrow path and make sure we are complying with everything that we have said.
So I said final, but finally in an election year, a lot of businesses, kind of multinationals, and they slow down because sometimes the uncertainty and whatever things are going to turn out and all those things. In terms of lending as well and transactions and all those things, are we going to see the banks being a little bit cautious because it's an election year?
No, but banks have always operated. We are here. I mean, we have nowhere to go as banks, and our job is to facilitate economic recovery. So long as you have a bankable project, it's economic recovery, and the banks will support you.
Mr. Ward, thank you so much for your time. I know that the discussion will still go on in your offices and homes about how the recovery in the banking space is impacting on their lending to businesses. My name is George Afia. He has been PM Express Business Edition with the Chief Executive of the Ghana Association of Banks, Mr. John Ewuah. Have a great day. We'll be right back with another interesting and exciting discussion that affects you as a business person and even as an entity. Have a great day.